Hello investors, welcome to one more monthly interaction with Canara Robeco Equities team. Uh, the event continues to be around the conflict between US and Iran. It has gotten extended beyond what we were initially estimating. Initially, our thought process was that given that there is enormous amount of pressure on US from domestic side, as well as there will be enormous cost to Iran in terms of the conflict, there will be a solution which will be found quickly. While still we are in just 2 months, and it is still not too much of a time, but it has still gotten extended beyond what we initially estimated. Our base case still remains that it will get resolved. Given that now, in terms of the context, it has gotten escalated even more, because now what we have a situation whereby the oil prices have moved beyond $100 lately. They are likely to sustain there, given that the Hormuz Strait is effectively completely closed for any transition for last few days or week, since the US has actually created additional challenges there. Now, how we look at it is that it puts further pressure on Iran, particularly while US, from its domestic perspective, was already under pressure. The US is going to go into elections in November. Trump's approval ratings have been falling, so there is already enough pressure on US. But now, with the blockade that US has created in the Hormuz Strait, the pressure on the Iran has substantially gone up in our view. And why we are saying so is fundamentally because till US blocked uh, the Hormuz Strait for Iran energy transmission, till that point in time, Iran had no economic cost of this war. Now the cost has multiplied multifold, because the cost has moved away from just military damage that was happening, and the economic cost thereof, to a actual economic cost whereby the energy exports from Iran has substantially gotten curtailed. And I think this is enough of a is effectively full-fledged sanction on energy exports from US. And the country which has so much of basically dependence on energy, how much time it can sustain with this blockade. And that's where I think both the parties still, our base case still remains that both the parties are eager, both the parties want to come to a conclusion. Of course, it's the positioning in terms of both the parties on particular aspects, like nuclear aspect, which is keeping the deal from happening. Our base case still remains that over next few days, few weeks, this should get concluded. There is enough disincentive for both the parties, whether it is US or Iran, to continue with this. Nonetheless, what is factually happened is that it has gotten extended beyond initial estimates of 1 or 2 months. And what it means is that it will have an implication for the global growth as well as local growth. It will have an implication for macros, and it will have an implication for micro if it were to persist. So that is the first aspect. I think all the equity market and all the economies are revolving around this, particularly the Asian countries, the Europe, the Africa is going to get and Middle East is going to get severely impacted because of these events. Now coming to the second part, that assuming that the base case doesn't play out and this situation were to persist for few more months, what is the scenario likely to be playing out? Our sense is, if this scenario were to persist for few more months, beyond say a month or so, then you are clearly going to have its macro and micro implication. And as far as India is concerned, we will be vulnerable on both sides. First, on macro side, you will have current account deficit at $100, which doubles effectively from about 1% to more than 2%, if the oil were to sustain at $100. In this kind of environment, to support growth, government has to, on one hand, it will have tax curtailment, and on the other hand, it would have to provide more, which means the fiscal deficit will go up anywhere between 0.3 to 0.5% on an annualized basis. Third, the inflation, various people, what they are penciling in at above $100, the inflation can go to anywhere between 4.75 to 5.5% over next few quarters if this situation were to persist. Not only on the macro side we have challenges, the challenge more from equity market perspective will be the way earnings will start panning out. This energy transition, as of now, has not been passed on to the consumer. In India is among very few countries where the energy prices have not gone up, despite the procurement prices going up by almost 50%. So the oil has moved from $70 to $100, but we are paying the same price on the gas station. There are various estimates whereby how much prices have to be increased, and the initial estimate is that the petrol diesel prices have to go up anywhere between 15 to 20 rupees to compensate for this increase. And as that happens, it will flow into the economy through various channels. So there will be two legs of impact. One will be the cost increases, which has its implications for cost structures and demand, which means the earnings will get cut on that count anywhere between 3 to 5% on an annualized basis if it were to sustain beyond a particular point. Second, basically the unavailability of lot of raw materials which are part of the basically value chain of oil and gas. Thereof, lot of industries will basically suffer in terms of the disruptions of supply itself. For example, the plastic value chain, for example, the chemical value chain, for example, the apparel value chain on polyester side, a lot of them might start suffering. The fertilizer value chain might start suffering because of unavailability of the enough of raw material, particularly the unorganized part of the economy. So that will be the second leg of impact, which will again impact the economic activity and the demand in the economy. So that's how the scenario is likely to play out if the base case of this event not closing over next 1 month, 1.5 months, and if the oil prices don't come back to $70-$80, this is the most likely scenario over next 6 months. Having said that, as of now, the base case for us still remains that it will basically get over very, very quickly, given now there is a substantially escalated pressure on Iran to also come to the terms, given that they are economically getting hurt now more than just militarily. Second aspect that we wanted to actually debate was the earnings. The earnings have panned out fairly well. The earnings are going for the fourth quarter. Just to put it in perspective, financial year 24-5 was 5% earnings growth. Financial year 26 first half was roughly 5% earnings growth. Second half, third quarter was roughly 8-9% earnings growth. The earnings growth had started trending up, and that is still visible in the fourth quarter number. Almost majority of the companies are either matching or beating the estimates. There are roughly 20-25% of the companies who have reported numbers, and on an average, there are more earnings surprises than the disappointments, and that continues with our erstwhile thesis that the underlying economy had started recovering. The credit growth has become 15% roughly in the system. The liquidity environment, despite all the challenges, is extremely good. The demand environment, both on the capex side as well as a lot of consumption sectors, has done well. The auto is doing well. The cement is doing well. So most of the sectors in terms of the economic recovery, so cyclical economic recovery on domestic front was underway, and that is reflected in the fourth quarter numbers till now also. Our sense is we will easily be anywhere between or we will easily actually go into double digit this quarter in terms of earnings. But that is not again very important, given that this will be backward looking earnings, and it is very critical that the earnings path which India was traversing, which is cyclical earnings recovery in financial year 27-28, which consensus has built in roughly 15% CAGR over next 2 years, that sustains. And if the war were to get over quickly, then I think that scenario is likely to play out. But if the war were to actually get extended, the energy prices were to remain elevated, you will have basically financial year 27 also being a challenged year in terms of the earnings recovery, because then the earnings growth will get cut. So those were the two key aspects that we wanted to debate. One, how we see this conflict and the energy prices and the scenarios that are likely to play out, and second is how is it likely to impact the earnings, and currently how the earnings are playing out. In terms of our portfolio, from a sectoral perspective, the portfolios are overweight on consumer discretionary, industrials, pharma, telecom, and part of financial services, whereas the portfolios are underweight on metals, oil and gas, IT, and staples. That's how our portfolios are constructed predominantly towards overweight on domestic cyclical side, whereby in sectors like financial services and part of consumptions, just like auto, the recovery was expected in financial year 27. But a lot of it hinges on how now the scenario plays out on the energy price side and in turn on the conflict side. So let us hope that it gets concluded over next 1 month, so that there are no significant macro or micro implications for financial year 27-28. In terms of valuations, the valuations for large caps are in an attractive zone, roughly 17 and a half times financial year 28. For mid cap, small cap, the valuations still are at roughly 23 to 25 times 1.5 year forward earnings. Although the earnings built in for the broader market, particularly small cap, mid cap, are far more benign as compared to previous 2 years. So there is no exuberance in the earnings, at least, while statistically they are still a little more expensive than their own historical valuations. Given this context, we are generally constructive on market from medium term perspective, but one needs to basically be cognizant of the fact that there will be volatility, and there can be significant volatility if these energy prices were to remain above $100 for a little extended period. While for sure it will come back to below a particular level or closer to the historic last year's level over next 1 year, 1.5 year. But how much time it takes to go there is going to be critical from financial year 27-28's earnings growth and the economic activity, and that's where there will be volatility, and investor can use that volatility to actually incrementally allocate to equity from a 18 to 24 months perspective. If the volatility were to come again, one time in March end you had volatility whereby the Nifty corrected to 20,000, 22,500. You can't rule out, if the energy prices were to remain at these levels, that kind of volatility again. If that were to come again, as I said, the energy prices will go down, if not in 2 months, 3 months, in 6 months. So from anybody who has a longer horizon of 24 months to 36 months, again any downside price volatility will be an opportunity to allocate more to the equities. That's largely from our side for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.